Momo invested $10,000, his coworker invested $10,000 too. Same amount, same year, same market. 10 years later, Momo had $14,800. His coworker had $19,400. Same money, $4,600 difference. Why? Because Momo picked the wrong type of fund, and nobody told him. Today, I'm going to make sure that never happens to you. Quick disclaimer before we start. This is not financial advice. I'm just here to educate. Always do your own research. All right, before we get into the types, let's understand what a fund actually is, because this is the foundation of everything. Imagine you and your friends are throwing a birthday party. Nobody wants to pay for everything alone, so you each chip in $20. With that pooled money, you can get food, drinks, decorations, a cake, and music. Nobody carries the whole burden. Everyone enjoys the full experience. A fund works exactly like that. A group of people pool their money together. That money gets invested in a variety of assets, stocks, bonds, real estate, and everyone shares in the results. Simple, clean. That's a fund. Now here's where it gets interesting, because not all funds are created equal. And that's exactly what cost Momo $4,600. Let's start with index funds, probably the most talked about type of investment on social media. You've likely heard this before. Just throw your money in an index fund and forget about it. But what does that actually mean? An index fund doesn't try to pick winners. It simply copies a list, called an index of companies. Think of an index like a scoreboard. The S&P 500, for example, is a list of 500 of the biggest companies in the United States. Apple, Microsoft, Amazon, Google. The bigger the company, the more weight it has on the index. When you invest in an S&P 500 index fund, you're basically owning a tiny piece of all 500 of those companies at once. If the market goes up, you go up. If it goes down, well, you go down too. But over the long run, history shows the market tends to go up. Here's what makes index funds special. No one is making decisions for you. They're passively managed. No fund manager picking stocks. Just a system that follows the index. And because there's no manager to pay, the fees are incredibly low. We're talking 0.02% to 0.20% per year. On a $1,000 investment, that's between 20 cents and $2 per year. One thing to know, you can't buy or sell an index fund at any moment of the day. Unlike stocks, index funds are priced only once, after the market closes at 4 p.m. That price is called the net asset value. So if you place an order at 11 a.m., your trade won't execute until the end of the day. For most long-term investors, that's totally fine. The biggest providers? Vanguard, BlackRock's iShares, and Fidelity. These are the giants. And here's why even Warren Buffett recommends index funds. It's extremely hard, almost impossible, to consistently beat the market. So why try? Now let's talk about mutual funds. At first glance, they look similar to index funds. They pool money from many investors and spread it across assets. But there's one massive difference. Mutual funds are usually actively managed. That means there's a real human being, a professional fund manager, whose entire job is to decide which stocks to buy and sell. Their goal? Beat the market. Outperform the S&P 500. Sounds great in theory. Here's the catch. That expert costs money. Mutual fund fees, called expense ratios, typically range from 0.5% to 1.5% per year, sometimes even higher. Now let's do the math. Say Momo puts $10,000 into a mutual fund with a 1% annual fee. His coworker puts $10,000 into an index fund with a 0.1% fee. Same market returns. Over 10 years, that fee difference alone costs Momo nearly $4,000. And here's the brutal truth. Most actively managed funds don't consistently beat the market anyway. Studies show that over 80% of active fund managers underperform their benchmark over the long term. Still, some investors prefer mutual funds for specific strategies or niche sectors. That's fine. Just go in with your eyes open. Like index funds, mutual funds also execute trades only at end of day. Alright, now we enter a different world entirely. Hedge funds. Forget everything we just said about simplicity. Hedge funds are private investment vehicles designed for the ultra-wealthy. We're talking minimum investments of $500,000 to several million dollars. They use aggressive strategies, short selling, leverage, which means borrowing money to invest more, and complex derivatives. The goal is maximum returns, regardless of market conditions. And because they swing for the fences, they can hit home runs or completely blow up. Now for the fees. Hedge funds are famous for what's called the 2 and 20 model. That's a 2% annual management fee plus 20% of any profits they make. So if your hedge fund makes $100,000 in profit, they take $20,000 plus 2% of your total investment every year, whether they make money or not. Why would anyone agree to that? Because for the right person, someone with massive capital and a tolerance for risk, hedge funds can generate returns that are simply impossible through conventional investing. But let's be real, hedge funds are not for you or me. They're not designed for everyday investors. Last but not least, ETFs, exchange traded funds. And honestly, these are my personal favorite to explain, because they're kind of a superpower for regular investors. Think of an ETF as a hybrid. It has the diversification of an index fund, your money is spread across hundreds of companies, but it trades like a stock. You can buy or sell it at any second of the trading day, at a live real-time price. Want to invest in the S&P 500 at exactly 10:32 a.m. because you saw it dip? You can. With an index fund, you'd have to wait until end of day. With an ETF, you act now. Fees? Usually very low too. ETF expense ratios typically range from 0.03% to 0.75%. And many brokerages now let you buy ETFs with zero commissions. There are ETFs for everything. The S&P 500, tech companies, healthcare, international markets, bonds, real estate, even gold. If a market exists, there's probably an ETF for it. Most ETFs are passively managed. They just follow an index. So you get low costs, real-time flexibility, and broad diversification all in one package. This is why ETFs have exploded in popularity over the last decade. Okay, let's bring it all together, because this is the part Momo wished someone had shown him on day one. Index funds, low cost, passive, priced once a day, best for long-term, hands-off investors. This is where most people should start. Mutual funds, actively managed, higher fees, may suit investors who want specific strategies or niche exposure, but check the fees carefully. Hedge funds, aggressive strategies, massive fees. For wealthy, high-risk tolerance investors only, not for the average person. ETFs, low cost, real-time trading, extremely flexible, great for most everyday investors, especially those who want more control over when they buy and sell. In short, if you're starting out, index funds or ETFs are almost always your best friend. They're boring, they're simple, and historically, they win. Remember Momo at the beginning? He lost $4,600 not because the market failed him, not because he was unlucky, but simply because nobody explained the difference between a 1% fee and a 0.1% fee. That's $4,600 that could have been his kid's college fund, his first rental property, his emergency savings. Fees are silent killers in investing, and now you know how to spot them. If this video just saved you from making the same mistake as Momo, hit that like button. It takes 1 second, and it helps me keep making these videos completely free for you. Subscribe if you want to understand money the simple way, the way nobody taught you in school, and I'll see you in the next one.